This PowerPoint demonstrates the accounting for the release of net assets from temporary restrictions for a not-for-profit organization. The accounting for the release of net assets from temporary restrictions is one of the most unique features of the accounting for not-for-profits. We will be using as an example the organization Community Facility Services, which is shown in Chapter 13 of your textbook. Now you should recall that net assets may be temporarily restricted as to program, which means that the donor or the grantor specified that the gift or grant could only be used for a particular purpose. Net assets may be temporarily restricted as to time. This might arise if the donor or grantor said that the gift or grant could only be used during a specific period of time, for instance, said it could only be used in 2014, or if the donor made the promise to give in 2013, but actually said that he or she would not be giving the money until 2014. That would also constitute a restriction as to time. And net assets may also be temporarily restricted as to plant. Plant restrictions may arise, again, from the stipulation of the donor or grantor. They may also arise from the organization's own accounting policies. Many organizations have a policy that there is an implied restriction on all plant and equipment assets. The events that trigger the release of temporarily restricted net assets are: net assets restricted to programs are generally released upon incurring qualified expenses. So if net assets are restricted to a particular purpose, once we incur expenses for those purposes, we can release net assets in an amount equal to the expenses. Net assets restricted as to time are released when the time requirements are met. So if the net assets are restricted and can only be spent in 2014, they are released at the beginning of the year 2014. And net assets restricted as to plant are generally released as the capital assets are used, that is, as they are depreciated. Remember, of course, that permanently restricted net assets are never released. So we are only dealing with the accounting for the release of temporarily restricted net assets. Now, for our organization, Community Facility Services, at the beginning of 2014, it had a total of $88,155 in temporarily restricted net assets. Those were made up of $3,900 restricted to programs, $79,130 restricted to plant, and $5,125 restricted as to time. And we can find these numbers in the trial balance for the end of 2013 on page 562 of your text. Now, we won't look at every journal entry shown in the text for Community Facility Services, Community Family Services. We are only going to look at the entries that have to do with the release of temporarily restricted net assets. So the first entry that impacts temporarily restricted net assets is entry number 1 on page 562. The agency received $5,125 of contributions in 2013, which were restricted for use in 2014. We saw this a second ago when we looked at the balance sheet for the beginning of the fiscal year and saw that there were $5,125 in net assets restricted as to time. When 2014 begins, the time requirement is met and the release is recorded with a debit to net assets released, expiration of time restrictions, temporarily restricted, $5,125, and a credit to net assets released, expiration of time restrictions, unrestricted, $5,125. Note that our net asset released entries always take this form, meaning there's a debit to the temporarily restricted account and a credit to the unrestricted account. The second event, which triggers the release of net assets, is entry 20A and B on page 567. Now, our organization's policy is that there is an implied restriction on plant assets. You can find this on page 561 if you're looking for it. Therefore, all plant and equipment is included in the balance, temporarily restricted net assets plant. And then as buildings and equipment are depreciated, an equivalent amount of net assets is released, and the entries are recorded as shown in entry 20A and B. So first, our organization records depreciation on its building and equipment for the year, and at the same time, it records the release of net assets in an equal amount with the debit to net assets released, satisfaction of plant restrictions temporarily restricted, and a credit to net assets released, satisfaction of plant restrictions unrestricted in an amount equal to depreciation expense $4,185. Now, the final entry, which triggers a release of net assets, is entry number 24 on page 568. During 2014, the agency incurred a total of $27,400 in expenses for programs which met the restrictions of contributions which had been received prior to 2014 and received during 2014. These expenses were recorded in other entries, so we're not going to make them here, or we won't see them here. But as part of its year-end adjusting entries, the agency needs to recognize the release that was triggered by these expenses, and it does so with the entry as shown: debit net assets release, satisfaction of program restrictions temporarily restricted, $27,400, credit net assets release, satisfaction of program restrictions unrestricted. Now at closing, of course, all of our temporary income accounts are closed to the appropriate net asset accounts. So any unrestricted revenue accounts are closed to unrestricted net assets. Any temporarily restricted revenue accounts are closed to temporarily restricted net assets. Any permanently restricted revenue accounts are closed to permanently restricted net assets. And almost all expense accounts are closed to unrestricted net assets, because remember, the accounting standard says that all expenses are treated as if made from unrestricted net assets. The only exception to this is some direct costs associated with fundraising projects. So if those fundraising projects are to raise money for temporarily restricted or permanently restricted purposes, those costs can be netted against the revenues from those fundraising projects. But for the most part, all expense accounts are closed to unrestricted net assets. At the same time, the net assets released accounts are also temporary accounts, and they need to be closed to the appropriate net asset accounts at closing as well. So our net assets released temporarily restricted accounts are closed with a debit to temporarily restricted net assets. So the effect of this is to decrease temporarily restricted net assets. And our net asset accounts, net assets released unrestricted accounts, are closed with a credit to unrestricted net assets. And the impact of this is to increase unrestricted net assets. So now let's look at the closing entries for our organization. I like to do my closing entries as groups based on each classification of net assets. So I would do the closing entries for unrestricted net assets. I would do the closing entries for each category of temporarily restricted net assets, and do the closing entries for permanently restricted net assets. The book shows it in a slightly different format, which I think is a little more confusing, so I prefer to do it this way. So let's just look at the closing entries for temporarily restricted net assets. So first we'll look at net assets temporarily restricted to time. So the closing entries, I would first close out any revenue account which is temporarily restricted, and we did have contributions that were temporarily restricted as to time, which were recorded in entry 12, so we need to close out that $10,000. We also want to close out our net asset released account, expiration of time restrictions temporarily restricted, $5,125, which we showed earlier. And our balancing entry is our net asset accounts, temporarily restricted net assets, time. So we close out revenues, we close out net assets released, we balance it with our net asset accounts, temporarily restricted net assets time, and the effect is to increase the balance in this net asset accounts by $4,875. We next do the closing entries for temporarily restricted net assets restricted as to plant. We received contributions during the year that were restricted to plant in entry 12, so we need to close out that revenue account. We also had investment income that was temporarily restricted to plant, which was recorded in entry 14A. We need to close out that revenue account. We also close out our net assets released account, net assets released, satisfaction of plant restrictions, temporarily restricted. And our balancing entry is our net asset account, temporarily restricted net assets, plant. And the net effect of these closing entries is to increase our balance in that net asset account by $1,205. Finally, we close out our accounts that are temporarily restricted as to program. We had various revenues that were temporarily restricted to program. They were recorded in entries 2B, 4A, 9, and 12. They totaled $32,750, so we close out that revenue account. We close out the direct costs that were attributable to program. These again were expenses associated with fundraising projects, which can be netted against the revenues raised by those projects. So it's an exception to the general rule that expenses only get closed to unrestricted net assets. We also close out our net asset released account, net asset released, satisfaction to program restrictions, temporarily restricted. And the net effect of these is to increase the balance in our net asset account, temporarily restricted net assets, programs by $2,350. So the combined effect of these three entries is to increase total temporarily restricted net assets by $8,430, which is the sum of the 4875, the 1205, and the 2305. And you'll see this number in the statement of activities on page 571, where it shows the total increase in temporarily restricted net assets of $8,430. So our entries are correct in this case. Now, if we were doing all the closing entries, we would now go back and close anything that needed to be closed to permanently restricted net assets. And then all the remaining temporary accounts would be closed to unrestricted net assets. And if you want to go through these, they're all shown in the chapter.